speaker, none other than T.R. Shankar, sir. We have given very short period. Within 2 days, sir has agreed. Generally, we give sufficient time, but when I requested, he immediately agreed for our request. I thank you, sir. I thank you on behalf of Bangalore branch of ICI, sir. It's a very interesting topic, provision under section 270A of income tax. This is going to be handled by T.R. Shankar, sir. Once again, I welcome you all for this program. Maybe today and tomorrow is the last program under my tenure as a chairman. Thank you all for supporting during all the programs. 24th is a baton handing over in the institute. I request all members to attend, grace that occasion. Thank you. I request our Secretary Pramod to give a brief introduction of Shiv Shankar, sir. Thank you.
Thank you, Chairman. I take the privilege in introducing Shri Shiv Shankar, a commerce graduate, BBM from Bangalore University, completed his BBM in PES College of Business Management, completed CA and CS in the year 2007 and Diploma in IFRS by ACCA London. He has secured All India 12th rank in CS Intermediate exam in the year 2005. He's completed his articleship in MSSV & Co. Chartered Accountants and served in MSSV & Co. in various capacity as manager, senior manager, audit and taxation. Now he's currently the partner in audit and taxation. His main area in practice are corporate audit and direct taxation. He hails from a village called Hiriyur, Tumkur district, Karnataka. With this brief introduction, I would like to welcome you, sir.
Thank you, Pramod.
I would leave the floor open to you, sir.
Yeah, at the outset, I should thank Srinivas sir and Pramod and Bangalore branch of ICI for giving me opportunity to express my views on Section 270A of the Income Tax Act. At the same time, Srinivas sir is kind enough to reach out and ask us so our schedule with respect to giving this kind of sessions. Sir, I personally thank you very much, sir, for giving this good opportunity for us to express our views. So let us start with Section 270A of the Income Tax Act. So as we know, as a professional members, so our day in and day out goes in filing the return of income, doing the assessments. After completion of that, it will come to penalties. Many of the times, we always think, or we can better convince our clients to pay the taxes. No problem. Interest is kind of consequential. That is also not much of the issue. The problem when comes to client or anybody to the pay the penalty. So how best we can understand the provisions and interpret the provisions and secure our clients to the best of our ability is very important, because paying the taxes, most of the clients are not having much of the issues, but the paying the penalty is always an issue. So today we are going to cover penalty under Section 270A of the Income Tax Act and immunity from penalty under Section 270AA of the Income Tax Act and other connected issues with respect to 270A and 270AA. So this Section 270A was introduced in Finance Act 2016 with effect from 1/4/2017. So this was introduced under Section 270A was introduced and it was replaced with Section 271(1)(c). Earlier, penalty for concealment of income or furnishing inaccurate particulars, Section 271(1)(c) was operational. After introduction of 270A, so this operation of Section 271 was kept in rest. So Finance Act 2019 made some few amendment to Section 270A with effect from 14/2017. The main objective of bringing 270A is to, in order to rationalize and bring the objectivity and certainty in penalty proceedings. At the same time, they want to reduce the discretionary powers and grade the penalties according to the level of categorize the mischief, or categorize the level of violations, or the kind of we call it as misdemeanor. So for that, so they have graded. Okay, so if it is a underreporting, the penalty rate is different, and misreporting penalty rate is different. Earlier, so there was a dilemma, or it is more of assing officer prerogative either to levy penalty from 100% to 300%. So he can levy any percentage before within 100 to 300. According to me, that band it seems to be very big. So if assing officer feels that 300% penalty or 100% penalty, the quantum is something which is kind of discretionary. That discretionary powers they want to take away and make it as a more objective and bring certainty. If you do any underreporting, so then the penalty is so much. If you do some misreporting, there is a graded penalty. So that is the intention in which the section 270A was introduced. Fundamental basis of levy is underreporting of income. So what do you mean by underreporting of income? Let us see that. Section 270A has totally 12 classes. Section 1 talks about levy of penalty. Section 2 talks about what constitute underreporting. If anything which will not fall under section 270A1 and 2, then you need not go further. 3, 4, 5, 3 to 12, we need not worry. We need to worry first whether it will constitute 1 and 2. Whether what constitute underreporting, we have to verify. Then how do we compute the underreporting of income? At the same time, what will be the penalty or underreporting in case of intangible additions made in the earlier years? Then some of the times we would have been a bona fide belief that so this is something is allowable expenses, but there is a change in the ruling, or there is a Supreme Court ruling will come. So that time you can always say, I was under the bona fide belief that penalty was not leviable. So that kind of bona fide beliefs and other exclusions are given in section 6, 270A section 6. Then quantum of penalty, how do we calculate the penalty and what is the rate of penalty is given in 7.8. And section 9, 270A9, it is very important. What constitutes misreporting? All the misreportings also underreporting. Underreporting is characterized by two things. One is underreporting consequent to misreporting. That will come under section 270A9. Then tax payable on underreporting of income, and no double levy of penalty, that is given in 11, and 12 is based on the order which will be in writing. So there is no problem on that. So totally we have 12 sections to deal with, 12 subsections to deal with 270A. So we will go by section. I will not go through the section in verbatim. I will be giving more examples and more live examples with respect to each sections. Now let us see section 270A1. So penalty under section 270A1 can be launched by assing officer, commissioner of appeals, or principal commissioner or commissioner. These are the 4 people they can launch the penalty proceedings under section 270A. Here is the word, it starts with may during the course of proceedings under this act direct that any person who is underreported his income shall be liable to pay penalty in addition to tax, if any, on the underreported income. This is what section 270A1 says. Let us see, it starts with may. The assing officer may during the course of proceedings. So I think they have consciously used word may instead of shall. So that means penalty under section 270A is kind of optional. It is not a mandatory penalty. That's what it suggests with the word using may. If you see section 271 1C also, there also it says if the assay is found to be the concealed particulars of income or suppression of facts, then assessing officer is may direct the assessee to pay the penalty under section 271 1C. So there also the word uses may, and here also uses the word may. So we very well know that in 271 one scenario where many courts held that so 271 1C is not a mandatory penalty. So the same arguments we can take it for 270A1 also, 270A penalty also. All the case laws which respect to 271 1C with respect to word may will also applicable to section 270A also. Here is the interesting proposition. During the course of proceedings, direct any person to pay the tax liable to pay penalty in addition to tax during the course of proceedings. Assessing officer during the course of any proceedings, he has to direct the person to pay penalty in addition to the tax. That means what? What do you mean by during the course of proceedings? During the course of proceedings means I will take an example of assessment proceedings. During the course of assessment proceedings, assessing officer has to direct the other person to pay penalty in addition to the tax. That means before completion of assessment, we have to pay the taxes or penalty. The wording says during the course of any proceedings under this act, direct that any person who is underreported his income shall liable to pay penalty under section act so and so. So that means they're trying to say before even completion of assessment, they want to levy the penalty. That is what the verbatim reading of section 270A1. But as we know, so after the penalty assessment concluded, so along with the assessment order, we will get the penalty notice. So when the assessment completes, the penalty proceeding starts. Here is the case where they are asking us to pay tax or penalty much before the conclusion of assessment itself. It is a valid ground, but however, if you see the proceedings, the calculation mechanism of penalty, so versus section 271(1) will not get reconciled. We will see later. So with respect to how do we reconcile this section 270A1 with other classes. Here is the three officers who can launch the proceedings. Assessing officer during the course of assessment under section 143(3) or 147 or 155(18). So this is the new insertion of section 155(18), where recently in Finance Act 2022, they amended section 48(2) to say that any surcharge education cess is not allowable as a deduction. Accordingly, they brought in section 155(18) to say that this is the mistake apparent on the record which has to be rectified by filing the application before the assessing officer in form number 69. If assessee is not failed to do so, he is considered as underreported his income. So that is what the language used in 115(18). So that means if anybody is already claimed education cess and surcharge as a deduction under section 37 or 40, so you have to file form 69 before March 31st, 2023. If you have not filed form 69 within March 31st, 2023, and if you have not paid the taxes within the notice given under section 156, then you are considered as assessee in default, as well as you are underreported the income. Accordingly, you are also liable for penalty. Commissioner of Income Tax, he can enhances the assessment under section while passing the order under section 250. So while enhancement, he can also launch the penalty proceedings under section 270A, where if he feels that you have underreported the income. Next, Principal Commissioner of Income Tax, in case of 263 proceedings, so if he comes to know that we have underreported the income, even he is also I am power to launch the penalty proceedings. What now we have understood who can launch the penalty proceedings, under which proceedings we can launch. Now, what constitutes underreporting of income? See, it is very important. Unless if something, all the cases, if it is not falling under section 278(2), then nothing will move further. So all the section, if at all, if it is falls under section 278(2), then only penalty is leviable, otherwise penalty is not leviable. So what constitute underreporting, we have to look at it. Here is the case: income assessed is greater than the income determined in the return processed under section 143(1). So that means I have an assessment order under section 143(3), which is more than what is determined, income determined in 143(1). So when there is a difference between 143(1) and 143(3), 143(3) income, if it is more than that, then it is considered as underreporting of income. So here is the case where my returned income is 100. At the same time, the intimation also processed under section 143(1) at 100. But assessment order, in the assessment order, there is an addition of ₹20, so at 20 lakh rupees. So totally my assessed income is 120. So if I compare 143(1) versus 143(3), there is an increase in my income, so that we can conclusively say that I have underreported my income. It is very important to note here that I need to verify, or I need to compare my returned income with 143(1)(a), not returned income with, or assessed income with 143(1)(a, and not assessed income with my return of income. It is very important. Your return of income is not a basis for levying the penalty under section 270(a). So what we have to look at it: 143(1) versus 143(3). See, next case, let us see. In this case, I have filed the return of income with 100 lakhs and I have a set off of 35 lakh brought forward losses. Totally my income was 65 lakhs. In 143(1), they didn't give this set off of losses, because in the earlier years there was some additions. Against that, I have filed an appeal. As per the earlier order, I was not entitled to carry forward that 35. They didn't give me carry forward losses in 143(1). However, from 143(1) time to 143(3) time, I got that appeal allowed, and accordingly I got that carry forward losses once again come back to me. So thereby, I in 143(3) time, I will get that 35 lakh carry forward loss set off. But assessing officer makes another 20 lakh rupees addition in the assessment order. Virtually, my total income becomes 95 lakh rupees. 95 lakh rupees. My returned income was 65 lakhs. My intimation, as per my intimation under section 143(1) is 100 versus my 143(3) is 95. Now what we have seen here, income assessed is greater than income determined in 143(1). So in my case, income assessed is not greater than income determined under section 143(1). So my returned income, my assessed income is 95 versus 143(1) is 100. If this being the case, it is not considered as a underreporting of income. Though if you compare, my return income was 65 and assessed income was 95, there is an increase in income compared to 143(1) and 143(3) and 140 return of income. So though, even then, it is not considered as underreporting of income. So whatever the addition or deletions what is made in 143(1) is not considered as underreporting of income. Ultimately, I need not look at each and every item in the additions what we have made. What we have to look at only total income. Total income as per 143(1), total income as per 143(3). In this case, though there is an addition of 20 lakh rupees, still I am not paying any taxes or in the form of penalty. First of all, there is no underreporting of income. Next, Next case where income assessed greater than the maximum amount not chargeable to tax, where no return of income is furnished, where return of income is furnished for the first time under section 148. I have not filed the return at all. So if I have not filed the return at all, so there is no question of passing 143.1. So once 143.1 is not there, the comparison with 143.3 versus 143.1 is does not arises. That's why what they say, if you have filed the return of income first time under section 148, or you have not filed the return at all, if that being the case, whatever the income assessed is considered as under reporting of your income. Because in the case of 148 notice, they will not process the return under section 143.1. So that's why they are telling, if you are not filed the return of income, or if you are filing the return of income for the first time, then whatever the income assessed is considered as under reporting of income. So it is always preferable and better to file the return of income, so get it processed under section 143.1 instead of not filing the return of income or filing the return of income first time under section 148. Next case. Here is the case where income reassessed is greater than the income assessed or reassessed immediately before the assessment. As we know, so after 143.3 assessment, there will be chances of getting assessment reopened by way of 263 read with 143.3, earlier 153A read with 143.3, 147 read with 143.3. So if that being the case, my underreporting of income will be whatever the present assessment order versus previous assessment order. If there is a difference in total income, then it is called as underreporting of income. In this case, my 143.3 was 120 earlier example. So now in 148, so our 143.3 read with 147, it was increased to 135. Compared to 120 and 135, there is an increase. Hence, it is considered as underreporting of income. These three cases is applicable for everybody. All the associates, these three cases is applicable. Now the case of companies and LLPs where 115 JB and 115 JC is applicable. The same logic is applicable. The book profit versus 143.1. Book profit as per 143.1 compared with book profit as determined under section R, assessed under section 143.3. If the assessed book profit is more than assessed or determined book profit in 143.1, then you are considered to be underreported of income. Next example, so where I have not filed the return of income or I have filed the return of income for the first time, so then whatever the assessed book profit as per 143.3 is considered as underreporting of income. In this case, assessee has not filed the return of income. Whatever the additions is made, that is considered as underreporting of income. Next, here is the case, the same case with C. Here is the case, there is a one assessment already completed and there is a one new assessment has come on account of 147 read with 143.3 or 153A read with 143.3. Then the book profit as determined in original assessment versus what determined in the new assessment, the difference, if it is a more in the new assessment, then it is considered as underreporting of income. So these are the these are the three. ABC is applicable to all the assessee. DEF is applicable to assessees to whom 115 JB and JC is applicable. That is companies and LLPs majorly, and few times it is firms. Next, this is the case is applicable. G is applicable once again to all the assessees. The income assessed or reassessed having the effect of reducing the loss or converting loss into income. If this is the case, then also you are considered as underreporting of income. So if you can see, I have returned income is 100 lakhs negative. At the same time, there is no addition in 143.1, but there is an addition in 143.3 when compared to my 143.1, there is a reduction in 143.3. So then there is a effect of reducing the losses in the current case. Accordingly, you have underreported the income. So next class or next scenario where we can see, here is the case where I have reported 100 as loss versus in 143.3, 143.100 also there is the same amount is determined, and next year there is an addition of rupees 120 lakhs. So thereby my income is converted into loss into income. In this case also it is considered as underreporting of income. There is a two circumstances here: reduction of loss or loss converted into income is also considered as underreporting of income. So here is the case we have. So let us see whether we constitute as underreporting. Very interesting issue, and this issue will come very regularly and frequently. So income from business before set off of losses is 100 lakhs, and I have brought forward loss of 150 lakhs. Brought forward from the earlier years, I have 150 lakhs. And the income processed before set off also 143.1 also 100 lakhs. At the same time, assessing officer made an addition of 20 lakhs in the assessment. If this being the case, whether my case will fit into the consequences of underreporting or instances of underreporting, let us see that. Here is the case. In all the three cases, what my return was 100 lakhs, and there is an addition of 20 lakh rupees. Thereby, my returned income is increased by 120, and I have a carry forward loss of 150. Out of 150, in return income, I have set off against that 100, and in 143.1 also they have adjusted 100. In 143.3, they have adjusted 120. Thereby my return of income, or what is the returned income or income determined in 143.1 versus 143.3, if you compare, both are same. So in this case, the loss is not, current year loss is not reduced, or current year loss not converted into income. What is getting reduced here in the current year is previous year loss is getting reduced on account of higher adjustment, on account of additions made in the assessment. If this being the case, whether assessee is said to have been underreported is income. So once again, I will read the line. The income assessed or reassessed as the effect of reducing the loss or converting such loss into income. So in my opinion, what section 272A, section 270A2G is referring to current year loss reduction or current year loss converted into income. So not previous year loss is getting reduced on account of addition made during the year, and I need not go into each and every addition made in the assessment order. What I need to look at, only total income. Compare the total income as per 143.1 versus 143.3. If there is no difference, then I am said to have not underreported the income. Accordingly, penalty provisions under section 270A is not applicable. This is once again debatable. This is my view, saying that when there is no change in the return of income, so no penalty proceedings under section 270A is leviable. Next, how do we compute underreporting of income? In the earlier slide, what we have seen, whether there is a underreporting or not. If there is a underreporting, then I will go to section 3. If there is no underreporting, I need not go to computation of underreporting. There has to be, in the first place, there should be underreporting. Then I will do computation of underreporting. If the return is filed, if I have filed the return, then amount assessed and amount determined under section 143.1, if there is a difference, that difference is considered as underreporting of income. What they are trying to say, so what we have already seen the example, 143.1 versus 143.3, if there is a difference, that is considered as underreporting of income. Here is the interesting issue. So I have filed the return of income. but I have not got 143.1 or my return is not processed under section 143.1. Directly they made the assessment under section 143.3. This is happening. So 143.1 is kind of not mandatory, where if the return is selected for scrutiny, in many cases they have not posted the return under section 143.1. If this being the case, then my basis for determining underreporting of income is 143.1 versus 143.3. In this case, according to me, computation fails, so charge also fails. So BC University case, so we can very well take that shelter. If there is an addition in the assessment order and 143.1 is not passed, then we can say that penalty is not leviable because the computation fails. Here is the case where my 143.3 is 150 versus my 143.1 is 110 lakhs. So my underreporting of income is 40 rupees. As per section 270 A3, it says that my underreporting of income with respect to this is 40. If in case of firm and LLP, amount assessed will be amount under reporting of income. In case of if the return is not filed, in the case of assessee is not filed the return of income, whatever the income assessed by the assessing officer is considered as under reporting of income. In case of any other case where you will get a exemption, like individuals, we will get up to 2.5 lakh rupees exemption. If that being the case, amount of underreporting will be amount assessed and maximum amount not chargeable to tax. That means up to 2.5 lakh rupees, it is not considered as underreporting. Over and above amount is considered as underreporting of income. In any other case, what is my total income assessed in earlier assessment versus income assessed in the new assessment is the difference between the earlier assessment and new assessment. As per 143.3 versus 147 read with 143.3, the total income, the difference is considered as underreporting of income. Here is the case where 147 is 180 versus 143.3 is 150. So the remaining 30 is considered as underreporting of income. In case I am a company or LLP where 115 JB and JC is applicable, where there is an addition for my book profits as well as in the normal provision, addition to normal provisions of the act. If that being the case, we need to follow this formula of A minus B plus C minus D. So A and B is nothing but the difference between the total income as determined in section other than section 115 JB and JC, and C minus D means whatever the total income or book profit determined in 143.1 versus 143.3. The difference between 143.1 and 143.3 for the purpose of book profit also considered as 150 C minus D. If this being the case, the both we have to add. So when there is addition for normal provisions of the act as well as book profits, then we need to add both. Then only we determine what is the underreporting of income. Here is the case. Let us see. My 143.3 income is 110 lakhs versus 143.1 is 80 lakhs. So there is a 30 lakhs underreporting in first provision, that is A minus B. And next is as per book profit, what I assessed is 210 versus my book profit as per 143.1A is 200. There is a 10. So in book profit, there is an addition of 10 and there is a normal assessment in as per normal provision, there is an addition of 30. So totally we said to have underreported to the extent of 40. So they will add both addition made in normal provision as well as addition made in book profits. In many cases, what will happen? The same addition what it will come in the normal provision will get added in book profits. For example, provision for doubtful debts. I have not made a addition as per 3617 as well as 115 JB or provision for unascertained liability. I have not disallowed in both the places. If assessing officers make the same addition both the places, then you, for the purpose of section D 115 JB, you need to ignore the one addition. The same addition, if it is made for both the cases, normal provision as well as 115 JB, you need to ignore for the purpose of D, calculation of D, I need to ignore. Let us see the example. Here is the example. 110 lakhs is the 143.3 income versus 143.1 is 80 lakhs. That 30 lakh rupees is an account of unascertained liability which has been added in the both income tax provisions as well as book profits. So that's why the 230 minus 200. So if I take the same example or same analogy what we have taken here, then my underreporting of income should have been 60. That is normal difference between A minus B plus C minus D. That's why they told, since the same addition is being made for the both B as well as A as well as C, for the purpose of D, you need to ignore that the same addition since it is already made in the addition in the normal provisions of the Act. Accordingly, we will get the underreporting of income 30 in the place of 60. Otherwise, what will happen? The same amount of assuming 30 lakh rupees added as a provision for bad debts or doubtful debts. If I make that as a 60 lakh rupees, on that I need to pay the taxes or penalty. I need to pay either 50% or 200%. We will come to that. Because of one addition, we can't make double penalty. To avoid that circumstances, they have given the proviso to section 270A(3). See, here is the chart where we can understand if the assessee assessed for the first time, if assessee is assessed for the first time, if the return of income is already filed, then my assessed income versus 143(1)A, the difference is considered as underreporting of income. If assessee is not filed the return of income, if it is a firm or company, whatever the amount assessed is the underreporting of income. In any other case, I will get basic exemption. Assessed minus basic exemption is my underreporting of income. In any other case, our assessment is already concluded, then I need to compare the new assessment order versus previously whatever the existing assessment order. If there is a difference between new assessment order and previously assessed income, so then you are said to have been underreported the income. Now, there are instances we say that penalty on intangible additions. What is that intangible additions? We say many times, sir, our books are not proper. We are the contractor. Okay, I will agree for GP additions. Okay, 8% of my turnover, I will declare as an income. I have declared, no problem. That year assessment is concluded. There was a bona fide belief. Everything was fine. Next year, I have constructed one house. And assessing officer asked the question, where is the source for this house? Then I will say, see, last year there is an addition of 1 crore rupees, which is an account of GP. That added amount I have invested in this new investment. We call it as a telescoping of income source, telescoping of source from application. So this year I have made a deposits or investment in the 1 year, and earlier year source I am showing as a to explain the source of this investment. If this being the case, then you are said to be underreported the income of the earlier year, because earlier year there was no penalty was levied, but you have made an addition in the earlier year. That earlier source you are showing today to explain the source for current investment. This is nothing but explanation 271(1)(c), which was already existing. The same proposition has been brought into section 270A4, where assessee gives the explanation to say that earlier income which was added in the earlier assessment as a source for the current investment, then in the earlier years you are said to be have been underreported the income. Accordingly, we are liable to penalty under section 270A for the earlier year, not in the current year. In the earlier year, you are liable to penalty under section 270A. Here is the example. There is an intangible addition of 2 crores in 21-22 and 2021 is 4 crores. Total addition made in the earlier year is totally 6 crores. In 22-23, I will say this out of 6 crores, I have made a investment to the extent of 5 crores. Then to the extent of 2 crores will be added as penalty under section 270A in the assessment year 21-22. Next example, intangible addition in 21-22 is 2 crores and intangible addition in 2021 is 4 crores and investment made in the current year is 5 crores. Out of that 4 crore rupees, already penalty, it was suffered penalty under section 270A earlier. So if already suffered 270A penalty earlier, then only 2 crore said to have been underreported the income. Out of 5 crores, I will say 4 crores is already penalty is levied. So what section 270A5 says, when there is a series of intangible additions and you are showing that series of intangible addition in as a source for the current year, you need to go by backwards. You can't say I have investment in 5 crores, but in 2021 4 crores I will take, and accordingly I am liable to penalty for 1 crore rupees. You can't say that. What they say that you need to chronologically go back. So accordingly, as for the assessment year 21-22, you are not paid 2 crore rupees on penalty on these 2 crore rupees. Hence, you are liable to pay penalty for assessment year 21-22. Here is the very interesting things will emerge. If the penalty proceedings was launched earlier and dropped, whether still I need to pay penalty under section 270A4 or A5 is the one question which according to me no, because they already, if the penalty is not levied earlier means it is not leviable earlier. Okay, it is already not leviable because of many reasons. You should have filed a application under section 270AA for immunity from the penalty, or there is a bona fide belief he is appreciated and deleted, or whatever the reasons. If the penalty is already initiated and dropped, in my opinion, the penalty once again should not be levied. However, it is not free from any other opinions are possible on this clause. So my opinion, once the penalty is already initiated and dropped, once again, we should not be ask them to pay penalty under section 270A4 or 5. The same observation. Then, so 270A6 gives some exclusions from underreporting of income. If any of the clauses, whatever is mentioned in 270A6 is found, then so much you need to reduce from the underreporting of income. What are those circumstances? Let us see that. One is bona fide belief. According to me, any penalty proceedings or anything, this is the basis. Whether 270A6A was there in the statute or not, even then we could have taken a shelter that I was under the bona fide belief. Here is the condition what it says. Assessee offers some explanation. There is an addition to assessment, addition in the assessment. Assessee offers some explanation. That officer, assessing officer satisfied with the explanation is bona fide. Assessing officer has to satisfy that whatever the explanation what you have given is bona fide, and assessee has disclosed all material facts related and substantiate the explanation. You have given everything. At the same time, you have offered some explanation. That explanation in the opinion of the assessing officer, or is satisfied that what your explanation is bona fide, then it is not considered to be underreporting of income. Here is the case where you have made some case of, we can take a case of section 80p disallowances. There are so many cases in so many high courts held differently. So in Karnataka High Court, based on Totagar, they say that interest income is taxable. In some other Gujarat High Court, they have told something else. If that being the case, if assessee takes the one view, possible view, and you go and explain to the assessing officer, see, there is a one more judgment of High Court which I have relied. Now there is a new judgment has come from the jurisdictional High Court from Karnataka High Court, which is against to that. Because of that, this addition is happening. So hence, I had a bona fide view, or to take this kind of stand, I had some backing. So hence, penalty under section 270A is not leviable. According to me, it is a bona fide belief based on the court judgment. If you have taken one of the view possible, it is 270A, penalty is not leviable. Next, when the underreporting of income is estimated, instead of 6%, you have offered under 6%, is increased to 8%. Or all accounts are correct and complete to the satisfaction of above. All the accounts, vouchers, documents, everything you have given. But assessing officer is not agreed with the method employed for determination of income. Assuming I am a developer, where I am doing the, I am offering the income under percentage of completion method. All vouchers, everything, there is no problem. But I have taken the estimated of income, that is the total expenses is 100 crores. He feels that 100 crores will not happen to complete this project. It is only 90 crores. Thereby, if he increases my income by based on estimation, then you can take a shelter under B. The only thing what we have to notice is the income should be estimated. Number two, there should not be any issue with your accounts or any documents. You have submitted everything. The only thing is your income is getting estimated. In this case, penalty will be, you are not said to have been underreported the income. Kindly note that bona fide belief is not required under class B. Only in class A, you need to show bona fide belief. If the income is estimated and you have given everything, and hence, then you need not show any bona fide belief in class B. Number 3, enhancement of estimation of assessee resulting in underreporting of income. Assessee estimated sum in respect of any claim or deduction, and such claim is reduced or disallowed in increased by the assessing officer. Assessee has disclosed all the material facts to the addition or disallowance. These are the additions which will normally have personal expenses. Personal expenses we would have taken as 30% of depreciation, or as my personal expenses. He increased to 50%. If he increased to 50%, then we can say it is only an estimation. At the same time, I am kind of okay. So smallness of the amount involved, I am not going to fight. So this cases 270A is not applicable. However, this 270A 6C is applicable only for claim or deduction, not for increase in the income. If there is an increase in income, section C will not applicable. Then we need to show bona fide belief. Bona fide belief, then I need to go and explain saying that there is a bona fide belief. When there is a disallowance, then you see whether you can fit into section C of 270A6. In case of transfer pricing adjustment, when there is a ALP adjustment by the assessing officer, assessee has furnished all the documents and is also maintained all the document prescribed under section 392D and declared all the international transaction in form 3CEB is very important. declared all the international transaction in Form 3 CEB and all the material facts is disclosed. If this being the case, then underreporting does not arise. So, this portion of the addition is required to be excluded for the purpose of calculating underreporting of income. It is very important where you have to declare all the international transaction in Form 3 CEB and you have maintained all the documents as prescribed under section 92D. Next, with respect to any search and seizures, any additions are made under which is where already liable under section 270 A, so then this is not a case of underreporting. That is a different case of penalty under section 270 A, that also required to be excluded for the purpose of underreporting. Then we have already understood what is underreporting of income, what constitutes underreporting of income, and how do we compute the underreporting of income. Then what are the things we have to exclude from the underreporting, we understood. Now, how do we calculate the penalty, or what is the quantum of penalty which we have to pay? We need to ask two questions: whether underreporting is in consequence of misreporting. If it is yes, then we have to pay 200% of tax payable on underreporting of income. If it is not on account of misreporting, then we have to pay 50% of tax payable on underreporting of income. So totally, we have two situations. One is 50% and 200%. If something which is not falling in misreporting, then everything will come under underreporting. Thereby, you have to pay 50% of tax payable as underreporting of income. Here we understood misreporting means 200% penalty. What constitutes misreporting? What do you mean by misreporting? They have given the circumstances or situation. In this situation or this kind of additions is considered as misreporting. If this being the case, then 200% penalty. If any of these cases is not fit into your additions, then we have to say underreporting of income. Misrepresentation and suppression of facts. Any addition made on account of misrepresentation and suppression of facts, then you have misreported the income. Accordingly, you have to pay tax penalty under section 270A at 200%. Example: short-term capital gain shown as a long-term capital gain and claim 54, 54F, 54EC. Short-term capital gain, so it is not entitled for any of these things. So this kind of misreporting or suppression of facts, then it will attract 200% penalty. Then failure to record investment in the books of accounts. I have invested, I have purchased one house, or I have constructed one house which is not there in my books of accounts. Or if that being the case, then you are misreported the income, accordingly liable for 200% penalty. Here is the case where assessee is an individual. Assessee is required to maintain the books of accounts only with respect to his business related stuff. But assessee has constructed one house which is out of the income what he has earned, or there is a source for that investment, but he is not recorded in the books of accounts that house, whether that will constitute a misreporting of income. In my opinion is no, because as per law you are allowed to maintain separately all personal assets and business assets in the books of accounts. In personal assets need not be clubbed with business assets. Accordingly, if an individual, if he has a source and he has kept two balance sheet, one is for personal balance sheet, one is business balance sheet, then you can't be charged with 200% penalty. A claim which is not substantiated by evidence, like bogus expenditure, a claim without any proper documentation, these kind of cases which will come under 200% penalty. Recording of false entry in the books of accounts, once again bogus entry, bogus purchase, or income received shown as advance, or loan shown as expenses, this kind of cases which will fall under 200% category. Failure to record any receipt in the books of account having bearing on the total income. Total receipt, not account. Sales receipt is not accounted as income. Failure to report any international transaction or specified domestic transaction. Interest on ICD, you have not reported in Form 3CEB, or royalty expenses not reported in 3CEB, which will constitute misreporting of income. Thereby, we are liable for 200% penalty. Here is the interesting case. What they say, failure to report any international transaction will attract misreporting of income. Just because I have not reported, but I already paid the taxes, or already it is there in the computation of income. Just because I have not included under section in the 3CEB, whether it will cause as a misreporting. On the face of it, yes, it is a misreporting, but when we come to the computation of underreporting or misreporting, section 270A2, so where there is no difference between assessed income versus income determined. Though I have not reported in 3CB, but I already included, but there is no addition in the assessment order. Though it is considered as a misreporting, it is not underreporting in the first place under section 270A2. Accordingly, computation under section 270A3, it is penalty under section 270A is not leviable. Then tax payable in respect of underreporting of income. Now I need to calculate what is my tax and penalty payable based on the underreporting. See, if I have not filed the return of income, so my tax payable under section for the purpose of section 270A is underreported income, which I have calculated under 270A3 plus maximum amount not chargeable to tax. Earlier, what I have done for calculating underreporting of income, I have reduced the maximum amount which is not chargeable to tax. For the purpose of calculation of tax, I am adding to that underreporting of income to calculate the tax. Let us see the example. Here is the case where assessee has not filed the return of income, where total amount assessed is 10 lakh rupees. In first case, underreporting, we have calculated under section 270A3, 10 lakh minus 2 lakh 50,000. That is underreporting of income. Tax on underreporting of income, once again, that 2.5 lakh rupees you need to add back and calculate the tax as per the slabs. 1,17,000 is the total tax he has to pay, and penalty he has to pay 50% of 1,17,000, that is 63,500 rupees he has to pay as penalty. If he has not filed the return of income, this is how we need to calculate. Next, if the total income determined are already assessed or in the previous assessment, if that being the case, my underreporting will be tax payable as per the income determined under section 143(1) and tax payable as per the assessment order. The difference is considered as my tax payable. Accordingly, I need to pay the penalty. Here is the case where my returned income was loss. That loss was reduced to 2 lakhs, 13 lakhs, it is reduced to 2 lakhs. Then my underreporting as per section 270A 3G is 11 lakh. On 11 lakh rupees, my tax liability is 1,48,200. On 1,48,200, I need to pay 50% of the penalty, which will come to 74,100. So if the assessee is already filed the return or income is converted into loss, this is the penalty. If assessee is filed for the first time, return filed for the first time in response to notice under section 148 or not filed the return, so then if he is an individual, I need to add back the maximum amount which is not chargeable to tax to calculate the tax and derive the penalty. In any other case, what is earlier in case of in the case of already 143.3 is already concluded. Now 143.3 read with 147 assessment is concluding now. So the difference between tax payable as per original assessment versus tax payable as the new assessment, the difference is considered as your tax payable for the purpose of section 270A, and on that penalty 50% or 200% we need to calculate. Section 270A(11), if any addition which is already suffered tax somewhere else, then once again you should not be levying tax under section 270A. This is very obvious. It's already levied penalty on the same addition on some other section. So then once again we need not levy penalty under section here. However, this is more of abundant caution. They have added 270A(11). Even if it is not there, that provision was not there also, it will be understood on the same lines. Then order passed under section 270A should be in writing. Any penalty proceedings before passing the order, they should give an opportunity of being heard, because they are levying the penalty which is prejudicial to the interest of the assessee. Accordingly, it is expected to give opportunity of being heard. Even then only they can levy the penalty. See, this is with respect to 270A penalty. This is one portion of the story. So whether we have any chance to get the immunity from this penalty, because there is an addition or bogus expenses are accounted, or some bona fide explanation which is assessing officer is not going to believe. All these things are ifs and buts. As we told first, they want to bring the objectivity, certainty in the assessment and penalty proceedings. That is the basis on which section 270A was introduced. Let us see whether they have achieved this objective by looking at immunity provisions also. If assessee can get a immunity under section 270A, assessee will get a immunity from three things. One is penalty for underreporting of income, then prosecution for willful attempt to evade the taxes. Even this you will get a immunity, and failure to furnish the return of income, that also will get a immunity under section 270AA, provided tax and interest payable under section 143(3) or 147 or whichever the recent order has been paid. You should pay in full before the specified date in the notice of demand. Along with the assessment order, we will get two other things. One is computation of income, one is notice of demand. Along with that, we are also getting 270A notice. 274 read with 270A notice also we will get. Totally we will get 4 in the faithless regime. Whatever the tax payable as per the assessment order, you should pay before the due date specified in the notice of demand. For the purpose of tax, you need to refer to assessment order. For the purpose of time limit, you need to refer to notice of demand. So normally notice of demand will be given for 30 days. Within 30 days, we need to make the payment. So you need to make the payment if at all any demand is there in the assessment order, which we have to pay. And no appeal has been filed against 143(3) order. If you are not filing an appeal and you already paid the taxes, then you need to make an application to assessing officer asking for immunity. If you make an application under section in 270AA read in form 68 in online, that application you have to make it in online. Very simple application. What is the date of assessment order as well as what is the tax payable paid, what is the due date of payment, as well as whether appeal is filed or not. These are on 3-4 questions they will ask. If you upload it and these are the condition, if you satisfy, you will get a immunity from the penalty proceedings. Assessing officer has to pass the immunity order under section 270AA within 1 month from the end of the month in which you made the application. If you make the application in the month of January, you will get the immunity order before 28th February 2023. If this 270AA order is not appealable, we can't question 270AA order in the form of appeal, but only we can file a writ petition invoking the extraordinary jurisdiction. The order rejecting, if the immunity is not granted or is rejecting the application, then he has to give a opportunity of being heard to the assessee before passing such an order. Here is the case where I got an assessment order under section 143.3 along with penalty notice on 27 December 2022. For assessment year 21-22 recently concluded assessment before December 2022. Now I got the assessment order on 27 December. Now last day to pay tax as per notice of demand is on 26th January 2023. If I pay tax before this date, then I am eligible for immunity. And also due date to make an application is 1 month from the end of the month in which I have received the demand notice and penalty notice. Then the due date will be, if I have received on 27/12/2022, then due date to make the application is 31/1/2023. So before that I need to make an application. Last date to pass the immunity order under section 270AA is 1 month from the end of the month in which I have filed the application. That is on 28 February 2023. He has to pass the order saying either accepting or rejecting my application. So virtually, if you can see, it is almost everything is getting concluded in 2 to 3 months. The whole process of completing the uh, getting the immunity, it is almost 3 months. We can say on 1st December, if you got order also, you would have completed everything in 2 to 2.5 months. The whole process will completed in 2.5 months. Thereby, income tax department collected the tax. There is no further appeal. At the same time, assessee is also got a relief from further proceedings in the form of penalty or prosecution and everything. So that for that year, everything will get settled if you go for 270AA immunity. These are the other points which we have to look at it before going into 270A immunity. Here they are referring tax and interest payable as per the assessment order only for the period you have to look at notice of demand. We already noticing so many discrepancies. As per notice of demand, there will be 10 rupees demand versus in assessment there will be 100 rupees demand. Which one I need to pay? These are the pure clerical errors which is happening from the NFAC, because we have only 30 days time to pay the taxes and within 1 month we have to file an application. For that purpose, for the tax and interest, I need to refer to assessment order or computation sheet. For only for the purpose of number of days, I need to look at notice of demand. You should not pay tax as per the notice of demand. You have to pay the taxes as per the assessment order. That is one of the important points. Whether assessee can file application under section 270A for misreporting also? No, the section 270A3 specifically bars for any application under section 270AA for misreporting of income. If the assessee, if assessing officer rejects the grant of immunity under section 270AA, you can file the appeal. Earlier, what they told, you should not file the appeal if you get the 270AA. If you want 270AA, you don't file appeal. So if the application under section form 68 is rejected, then you can file an appeal, no problem. So whatever the time limit for filing the appeal was for filing application and in 270AA and the date of assessment assessing officer order rejecting my claim of immunity will be excluded for the purpose of calculating number of days. within which I need to file the appeal. As we know, we have only 30 days time to file the appeal. I have filed application on 25th day for immunity. Here is the case where my assessment order on 27/5/12/2022 and application for immunity I have filed on 21/2023, and assessing officer passed the assessment order rejecting the immunity on 15/2/2023. Then can I file the appeal? Yes, I can file the appeal. The time limit between 21/2023 to 15/2/2023 will be excluded. So accordingly, almost I will get 35 days. It will be excluded. What is already run the timing. So 27/2 I should have filed before 26/1/2023. I have filed the application on 21/2023. I will get another 6 days to file the appeal. If it is more than that, I need to file condonation application and accordingly file the appeal. If this time is required to be excluded, that is what we have to look at it. Next, other issues. See, other issues. Assessing officer passed, while passing the order, he made some mistakes in calculation of taxes. The classic example is 234 ABC, which normally there are many errors. That is number one. Number two, self-assessment tax not considered. Advance tax not considered. TDS is not considered. I have no problem in paying the taxes and not filing the appeal. I am okay with that. But because of this, the demand what it's showing in the assessment order is more. Assuming 5 crore rupees self-assessment tax which is not paid, which is not considered, along with 5 crore rupees interest, everything would have been 8 crore rupees. So to get this immunity, the two conditions are very clear. I need to pay tax as well as interest within 30 days and not file an appeal. How do I pay the taxes and interest which is already paid? To what the circular one FAQ says, if possible, you pay the taxes and seek immunity and then ask for rectification. That is one possible view. Number two, immediately file the rectification application and get the rectification done within 30 days, and then you file the application under section 270 AA. So if you are not able to get that rectification done within 30 days, then if you want the immunity under section 270 AA, you have to pay tax along with the interest. Even though it is not at your fault, you need to pay and then you have to ask for rectification. Assuming if he is not doing the rectification, whether I can go, or if he has done the passed the rectification order, but once again there are some mistakes, whether that order is appealable. Yes, that order is appealable. Only order under section 143(3) is not appealable, or whichever the order on which you are asking for immunity is not appealable. If rectification order on which you want to go for an appeal, it is still allowed. You can take the immunity and still you can ask for recourse under section 154. So no problem with respect to going appeal against order under section 154. Assessing officer, while giving the notice under section 274 read with 270A, it is actually under-reporting case, but he has mentioned misreporting. As per section 270A, 270AA3 specifically bars from going to assessing officer for any immunity for misreporting cases. If my case is misreporting, but I know that it is not misreporting case, it is a under-reporting case. So if that being the situation, my advice will be make an application to assessing officer not to file a appeal and go and explain saying that this is not a misreporting case because none of section 270A9 is applicable here. So it is only under reporting case. Accordingly, you need to drop the penalty proceeding by granting immunity. So we can conclude that penalty proceedings for underreporting is mandatory. If we have satisfied only two conditions I need to satisfy. One is I need to pay the taxes, not to file an appeal, file application. These three things are, if I do it within the time limit, then assessing officer has no discretion to reject my application. He has to take it and he has to give the immunity. There is no discretion. I think very objective certainty what they are referring in the memorandum, according to me, with respect to certainty, definitely they have achieved. Everything is time bound and there is no discretionary powers with respect to granting immunity under section 270AA. But in the case of misreporting, and you have to go and convince to him saying that it is not a case of misreporting, but it is a underreporting. So if he is satisfied, he might give immunity, but it is kind of discretionary. To that extent, we are in their mercy. That is number one. Number two, my advice will be, if you can, during the course of assessment itself, if you make the addition, it is not a case of misreporting because I have produced all this document and based on my submission only you are making an addition. Don't make it as a misreporting, but you can make it as a underreporting. That kind of submission you have to make it during the course of assessment and bring it to the knowledge of the assessing officer. You should not make a mistake while selecting whether underreporting or underreporting consequent to misreporting, so that we can avoid all these complications. Here is the case where there are two additions are made. One addition is in the nature of underreporting and another addition is in the nature of misreporting. If this being the case, the question number one will be whether I can ask for immunity from penalty under section 270AA only to the extent of underreporting, whether I can do it. Because the conditions under section 270AA is I should not file an appeal, but I want to file an appeal to the extent of misreporting. To the extent of underreporting, I will pay the taxes and I want to be done with that. So whether it is possible? In my view, it is not possible because they want to reduce the number of litigations. If you want to pay the taxes and not file the appeal, to the extent of underreporting, you will get a immunity for sure. For misreporting, you might have to fight for it. So you can't go appeal as well as you can't ask for immunity under section 270AA. It is not possible. However, contrary view is also possible, saying that I will go for an appeal, but I will not raise any ground relating to underreporting of income. I will only raise the ground with respect to misreporting of income. So thereby I will not file the appeal to the extent of underreporting. Accordingly, I have satisfied conditions as per 270AA. But however, I have my own apprehensions. So that might be not both the views are possible. Next. In the assessment order, assessing officer has written saying that I am going to initiate the penalty proceedings for underreporting of income. But in the notice under section 274 read with 270A, they mentioned that it is consequent to misreporting. There is no reconciliation is not happening with respect to assessment order as well as 270A notice. In this case, whether the notice of 270A notice is valid, so still we can take all the case laws which are there in 271(1)(c) with respect to giving the notices, printed notices, without scratching the portion which is not applicable. You can't take that kind of notices. You can very well rely on the Manjunatha cotton and ginning factory, where Karnataka High Court held that if that notice under section 270A is printed notice where the underreporting is shown as a misreporting, or under-reporting / misreporting, if this kind of written things are there, then the whole proceedings is void. Penalty proceedings are void. Accordingly, no penalty is leviable. Still, the 271(1)(c), all the import from there, it can be taken and argued here. Penalty levied by CIT appeals by enhancing income or PCIT in the revision proceedings, whether 270AA is allowed. So here in 270AA, only additions made by the assessing officer alone is eligible for immunity. Any addition made by CIT appeals or commissioner is not allowed to get a immunity from the assessing officer. Section 270AA is only for the additions made by the assessing officer, not the commissioner and principal commissioner, because we know that in the 270A, first one only we told there are 4 officers in fact, who can initiate the penalty. One is assessing officer, one is commissioner, one is commissioner appeals, one is principal commissioner. All these 4 officers can initiate the 270A penalty, but only additions made by the assessing officer is alone is immunable under section 270AA and not other additions. What are the precautions we need to take while making an application under section 270A? One is, if you think that my case might fall, might not get the immunity, you need to think twice before making application, because to make an application you need to pay 100% of the tax. If they get rejected, then once again we need to go to an appeal. For appeal to get a stay, you will have to pay only 20% tax. So if this being the case, whether in the first place, whether I will apply 270AA and take a chance or not is something which we need to look at it, because after paying 100%, I should have paid 20% and I would have fought the case in CIT appeals. You need to file the application for immunity before the due date for filing the CIT application, CITA due date for filing the appeal before CITA, because we know that within 30 days we need to make an application, file an appeal to CITA. But however, I have 1 month from the end of the month in which I have received the notice to file the application to immunity. Assuming I have received order on 1st December 2022, I have up to 31st January 2022 to make an application under section 270AA. If by any chance, if it is get rejected, here the time limit is already elapsed on the date of making application, then I need to go for condonation of delay and I need to give valid reason for condoning delay. So it is better to file the application under section 270AA within 30 days. According to me, 30 days also it is too much. You might have to think within 25th day you have to make the application, so that in case of rejection you can always come back to appeals. And if you feel that there is a 50-50 chances or there is any chances that they might reject the immunity application, then keep the appeals paper ready so that you can file the appeal immediately. Next is, these are the steps we have to follow after receiving the assessment order to complete the whole process without any loopholes. First, I will receive the assessment order along with penalty notice, computation, notice of demand, everything I will receive. That is the first step. Number 2, I will think of going to 270AA application instead of going to CITA, so that I will thinking of satisfying all the conditions. That is step 2. Intimate the assessing officer first, saying that I am going under section 270AA. Accordingly, don't pass 270A order. Normally they will not pass, but better to intimate assessing officer about your application. That is number 3. Then pay the taxes along with the interest within 30 days. Then file application in form 68 within 1 month from the end of the month. Assing officer normally issues the notice under section 27 show cause notice they will issue. What I understand from the income tax officer, without issuing show cause notice, they can't pass the order in the system. So normally immediately the moment you file a form 68, they will give a show cause notice to say that kindly elaborate how you have completed the conditions specified in section 270A1. If that being the case, I need to reply to the show cause notice under section 270A1, and assing officer will pass the order accepting or rejecting my application. If immunity is granted, then write a letter to the assing officer to drop the 270A penalty proceedings. Kindly note that 270AA and as well as 270A are two different proceedings. It is not though it is automatic, but in system, whatever the immunity you got it, you need to go and intimate saying that, so I have already got the order, this is the order, request you to drop the proceedings. Number, if the immunity is rejected, go and file the appeal to the CIT appeals. If assing officer keep the penalty proceeding and ask for keep the penalty proceedings in abeyance until the disposal of appeal. If you are going for an appeal, ask him not to dispose of the appeal, because the moment if he dispose of the penalty proceedings, against that penalty proceedings also you need to fight. So it is better to ask him not to go ahead with the penalty proceedings until the disposal of appeal. So these are the 11 steps, which is something which we have to do it, so that it will come to all the steps we have concluded, so that there is no loophole is left out. Assuming I have not paid the taxes on 30th day, I have filed on 31st day. I supposed to have paid the taxes 30th day, I have paid on 31st day. Is there any chances that still we can get the immunity? If that being the case, you need to make an application under section 119(2)(b) and ask for condonation of delay. And section 119(2)(b) empowers the officer to condone any of the provisions in the Income Tax Act, including 270AA, which is not specifically mentioned, but you can go under section 119(2)(b). And in the 119(2)(b), there is a CBDT circular based on the monetary limit. Who is the officer who can take a call on the condonation is given. If it is more than 50 lakh rupees, we need to make an application to CBDT. If it is less than 50 lakh rupees, we need to seek the approval of Principal Commissioner of Income Tax. So if he gives the condonation of delay, so then still we can get 270AA through. So these are the views with respect to 270A and 270AA. So I am happy to answer any of the queries or any of the questions relating to 270AA and 270A till now we had. So we have few questions. Whether disallowance under section 14A or any other disallowance made on estimated basis by the assing officer falls under the exclusionary provisions of section 270A of the Act. Disallowance under section 14A definitely is based on the estimation. Okay, so that expenses that you have already given all the documents, the assing officer disallows, but that is on an estimation basis. But according to me, you need not go into that clause under section 270A 6C. Don't go to C, come to A 270 A 6A 270A 6A, where you say that is a bona fide belief. There are so many other cases which are in the same circumstances where they have held that on 14A it is only an estimation, penalty is not leviable. In 271 1C provisions, as far as you have bona fide belief, you prove your bona fide belief in section A instead of going to section C. Next, if the notice under section 270A is not issued along with the assessment order but issued after 6 months, can I take immunity under section 270A of the Act? There is no time limit for issuing notice under the Act. This is very good question. So definitely it is a valid question. Without 270A application, I can't go for 270AA. That is the minimum thing. But If I have not filed the appeal or within 30 days, I have already paid the taxes. These two conditions, if you satisfied, once you receive the notice, still you can file the application immunity from the penalty. But this is more of practical solution. But it is very clear, as you said, it is very clear there is no time limit for issuing notice under section 270A. So they need not attach the 270A read with 274 notice along with the assessment order. They can give any time. However, so what as an assessee I can do to get the immunity is only pay the taxes within 30 days and not to file a appeal. If these two conditions already satisfied, the moment you get a 270A notice, you file an application for 270AA. And number three, if that is not possible, file an application under section 119(2)B, and you say that there is no way I could have filed a 270A application when there is a 270A application was not there. Accordingly, this your application, according to me, it should get through. If the assessing officer initiate a penalty as misreporting, but ITIT decides as underreporting of income, can I get a benefit under section 270AA of the Act? In my opinion, no, because it is once again the time limit within 30 days. Within 30 days from the end of the month in which I have received the thing, I need to file the application under section 270A. And further, you already filed the appeal in the first place. For this kind of situation, my approach will be, I will file the application under section 270A first, and then I will argue saying that this is not a case of misreporting but is underreporting. Let him reject that. Then I will file an appeal. Then in ITIT, if he holds that it is underreporting, then I will make an application under section 154 to 270AA. It is not an appealable, but it is a mistake apparent on the record. Whether it is possible, it is something which we have to, test over the period of time. So what we have to do, first you file the 270AA and get it rejected. Then you take a appeal route, and then somewhere in ITIT, if he holds that it is not misreporting, is a underreporting, then you ask for rectification of 270AA order what is already been passed. This is something which I am giving some practical solution without any backings. So it is not a clear cut answer, but I would definitely this type of situation definitely will arise. Next. Hi, sir. Assessee has filed the immunity request to AO by a request letter, not through Form 68. AO has rejected immunity. All the conditions are met except this, whether assessee has a chance in CIT appeals. I would say because 270AA, the process itself, it is not appealable. If that being the case, you mention everything and ask for condonation of delay for filing under section 119(2)B. We have made in one case, they have granted. So assessee has paid on 31st day instead of 30th day. We have filed a condonation application. They told that it is not even one day, it is few hours. Instead of on that 30th day before 12 o'clock I should have paid, I have paid on 31st day morning 10 o'clock. It is not even one day, it is few hours delay. Hence requested to be condoned. They have condoned. So they have a power to condone. So instead of going to CIT appeals, think of going under section 119(2)B. If 119(2)B, if it is not been favorably taken, file a writ petition saying that this is very not taking very correct view of law. Are you please share the PPT? Okay, that branch can share. If proof of expenses provided is not accepted by OVO, order is passed, it will come under misreporting or underreporting. If proof of expenses is there, if it is not accepted, once again, it is a case of there are two things. One is there is a genuine bogus expenses, or it is a bogus expenses in the first place, and that is considered as misreporting. Just because he has not accepted, that doesn't mean that it becomes bogus expenses. So thereby, according to me, we can take a call saying that make an application, whatever, even if it is get rejected also, we have second chance to come to appeal. You take but only thing is you have to pay the taxes and then you have to make an application. If it is a worth taking that kind of chances, it is better to take chances and explain, saying that I have all the vouchers, but you have not considered, or you have not looked into properly, or I have not come and explained you properly. Now I am doing all these things. And in 271 1C proceedings, there are cases they told very clearly assessment proceedings are different from penalty proceedings. What I have not shown in the assessment proceedings, I can very well show in penalty proceedings, and still I can make my case. No problem on that. Whether the penalty, whether the notice under section 278 can be issued along with the order under section 143, or order with no, not 154. Penalty under section 154, no, penalty is mistake apparent on the record. On with 154 you can't do, but however there is a new provision for education cess and surcharge, where again along with the order under section 155/18 they can give notice under section 270A. So any more questions are there? I am happy to answer.
I think Aster Web, sir.
Okay. I thank Bangalore branch of SIRC of ICAI for giving me opportunity to express my view on section 270A and 270AA. So that I am very grateful to you, sir, as well as branch. I special thanks to Mr. Srinivas. He has given an opportunity at the end of his tenure to express my views on 270A. Also thank Bangalore branch, Mr. Pramod Hegde, as well as all the office bearers of ICA, Bangalore branch of ICI. I also thank my partner, my mentor, dear Venkatesh, of partner of MSSV, without whom I would have not been here. Also thank my partner Sandeep and my colleague Rohit, who has helped me in preparing this presentation. So I thank you all for giving me opportunity and express my views. Thank you very much.
Thank you, sir. Thanks a lot. Really, it was a great session. Fortunate to have two sessions in my tenure. Really, I'm grateful to you and Sandeep and entire your team for always, whenever you invite, you come and addressing our members. Really, it was a knowledge filled session. Thank you on behalf of Bangalore branch of ICA for taking this session, sir.
Thank you very much, sir.
I also thank all the members for actively participating in this program. Thank you.
Thank you. So there is a one last question has come. So let me try to answer that question anyways. Assessee has not filed the return for assessment year 17-18, has salary income of 58 lakh rupees, TDS correctly deducted, order under section 270A or to 147, 140 amounting to lakh. Is there any way out, or at least any other case law? Sir, section this 270A has come only from assessment year 17-18, and order under section 270A passed in some around August September 2022 onwards. I think case laws ke liye we might have to look at it, but there are some technical points what we have told. So whether we can challenge on the validity of notices, whether the notice versus assessment orders where there is no link, that kind of things you can still take a chances and you can argue on technical points. Thank you.
Thank you, sir. Last over, last ball, arbitrary. Very good. Thank you.
Thank you very much, sir.